Hello again and welcome back to Count Me In, IMA's podcast about all things affecting the accounting and finance world. We have a unique episode for you today as both Mitch and I facilitated a conversation with two guests to provide multiple perspectives on the topic of sustainability. We spoke with Sherry Litton, IMA's Manager of Corporate Reporting and Technical Activities, and Mario Abella, a Director for Redefining Value at the World Business Council for Sustainable Development. Let's head over to the in-depth conversation held about topics relating to sustainability, such as ESG and integrated reporting.
There have been many articles and publications for guidance on sustainability. So to start things off, what is sustainability and why are organizations so concerned about it?
Thanks. There are many definitions of sustainability. From the very narrow, it's just about the environment through to the intergenerational legacy that we leave for future generations to be able to kind of enjoy the same lifestyles and the same resources that we've been able to enjoy today. So the term doesn't really have any fixed meaning, and it continues to evolve. At the WBCSD, when we talk about sustainability, we're really looking at the sustainability of the business model. Can the business continue to operate as it's currently doing? Can it sustain those operations into the future?
I just want to recall that for me, when I first became fascinated by what we'll call accounting for sustainability or integrated reporting, I always recall my reaction to the first photos that the astronauts sent back. One of the famous photos is called Earthrise, and you can actually see the Earth rising from the surface of the moon. And many people say that the modern environmental movement started with that photo because all of humanity reflected back on what a small planet that we have. And to me, coming with an accounting background, I think of one of the primary goals of why we have accounting to begin with, which is we have limited resources. And that picture coming back is a stark reminder that resources here on Earth are limited. So we have to be a little bit broader or maybe evolve what we account for, how we're using those resources, how are we all allocating our precious resources, what are we doing with them? So for me, that one photo ties back to accounting. And when I am thinking about sustainability and business, for me personally, that's where I come.
So then what kind of relevant data is available for sustainability and how are businesses reporting this information? In other words, what is the current challenge?
The problem is that the relevant data isn't really being reported. So there's been a number of surveys done by the CFA Institute and other investor bodies that have demonstrated that there's actually no shortage of data and to some extent information, but that information is not particularly relevant to the sorts of decisions that investors and other stakeholders need to make. So if a board were to ask management about the reliability, a lot of sustainability metrics reported today, a lot of CEOs would struggle to really put their hand on their heart and commit to the credibility of the data. And in fact, PwC, in its CEO survey, looked at what are the sort of key decisions that CEOs need to make about their company, and then what sort of information are they getting, and to what extent do they have confidence in that information. And for a number of data points where these things are absolutely critical to the business and its value creation, in fact, they either don't get very much data, or the data they get, they have very little confidence in. And we have to remember that a lot of this data is not subject to internal assurance. So often it's not, there are no reviews done by internal audit, and it's also not subject to external verification either. And the other point is that companies now report, as you know, in many different, through many different channels. So the 10K is just one form of reporting, but companies report, every minute through social media, and then there are news outlets and others who are also providing information about companies. And we did some work last year where we went around the world and spoke to investors about ESG information. And one of the things that they told us was that at the moment, because there's a lack of standards, or at least a single standard, because there are many frameworks, many standards of sorts that we've identified at the WBCSD. In fact, we've counted at least 200 frameworks with over 5,000 indicators. The problem for investors is comparability. They've got no idea how to compare one number against another number, because the basis upon which those numbers are calculated are often very different. And so what happens in practice is that companies use a mix of measures from existing frameworks, and then often adapt them to their own requirements. So we have entity-specified criteria, which makes it even more confusing. And the other issue in all of this is that at the end of the day, we understand our accounting calculations. We know that making a profit where there's a kind of excess of revenue over costs is a good thing, and that's what companies should do. And we know that making a loss, particularly a persistent loss, is not a good thing, because it means that there isn't sufficient revenue to cover costs or to reward the providers of capital. But when it comes to a lot of these sustainability areas in the social and environmental domain, it's less clear. What's a good number for the percentage of women on boards? Is it 20%? Is it 50%? Is it 75%? So these normative judgments about, well, what's good are very difficult to make. And so that is also an issue for investors, because even on greenhouse gases, take two, comparable S&P companies with very similar activities. What's a good number in terms of their greenhouse gas emissions? Well, it depends. Depends on the stakeholder. Depends on what outcomes in particular you're trying to pursue. So there are lots of challenges really in not only pulling this information together, but then in making sense of it.
And how about specific to the finance and accounting team? What role are you seeing CFO teams and these finance and accounting professionals taking with respect to sustainable business performance information?
Yeah, so what we're doing here at IMA is we're taking a little bit of a listening tour for our constituents who mostly sit in what I'll call a CFO unit or finance and accounting on the corporate side. And here's what we're hearing, that the gathering and reporting of what we'll call sustainable business information has grown up outside of their unit, that it's primarily by a unit with a title of corporate social responsibility or sustainable business, but outside of the what we'll call the mainstream finance and accounting unit. But as the company focuses more or takes more initiative and progresses in its understanding and its desire to use this perspective for we'll call long-term performance and value creation, it's inevitable that the CFO team, members of finance and accounting, are getting involved. And when they do, it's amazing what they tell us is that suddenly there's a new different eye, because the CSR teams, as Mario says, can be sitting on tons of data that's really valuable and talks to various aspects of the business that haven't been looked at before. But that data needs to be analyzed with that professional eye, the rigor, the professional experience in auditing and controls, and bringing vigor and rigorous oversight to the data itself. Here's what one said is that our finance team, they don't take our numbers at face value. As that progresses, we see that the finance team, accounting and finance team, takes even more of a role. They get involved and they start saying, well, why can't we get better data? Can we put some of these metrics into our mainstream ERP system so we have some oversight? We know what we're gathering and we know what we're reporting on. And we see companies that, as they take steps to understand what investors are demanding, to look at the various frameworks that Mario talks about and say, well, what's most relevant to our business? That takes that finance and accounting eye sometimes to say, how do we put it all together? And the people who are sitting in what I'll call the CFO unit have that expertise to help bring that forward.
So then to connect this all together, what are the benefits of the involvement of corporate finance and accounting professionals?
So as I mentioned, when we see members of the accounting and finance team get involved in sustainable business information, internal and then for external reporting, we see more of a compliance mindset, and in some cases, actual controls. The traditional COSO framework can be applied, and that oversight of the data because in many ways, the flow of information, whether it's sustainable business information or strict monetary information, it's a similar process. You're deciding what you're going to report on. You gather the data, you summarize it, you analyze it, and put it in a report, whether for internal or external use for decision making. So that process is the same. When we have that controls and oversight internally over the data, when that finance team brings that expertise, it enhances the quality of the information and it enhances the reliability. So it makes the whole reporting process, it makes the activity of looking at your sustainable business activities more relevant, more reliable. It brings credibility to it, and thereby it creates value just by deciding on what information is good and what information is less good. And this also helps, as Mario was saying, with the view of the marketplace, because as companies are able to understand and speak to these issues and begin to incorporate them with an enterprise mindset, it does speak to investors and other stakeholders, and in fact it shows indicators of good governance, that management is looking at these issues, that they're not narrowly focused, and that helps engage with investors and other stakeholders. And as Mario mentioned, can be a way to engage longer-term investors and lower your cost of capital. And we're seeing the research bear that out.
Just to follow on, Shari, we did some research in 2018 where we extended a study we'd done previously, and we looked at some of the largest companies in the world. And we looked at their 10K and what they'd reported in terms of their risks. And then we looked at their sustainability reports. And for the same companies, we found that only 8% had the same risks listed in their sustainability report as they did in their 10K or statutory financial filing, which is a kind of staggering figure, but it really just stresses this point that with sustainability information, often we're not talking about, or we're not starting with a single source of data. And so there are a number of preconditions we need to satisfy in order to be able to implement some of the measures that we would take for granted when it comes to financial information. It's also the nature of that information. As Sherry has pointed out earlier on, this is a diverse set of information. Some of it is monetized, some of it is not monetized. If we're talking about greenhouse gas emissions, water usage, these aren't necessarily monetary amounts. We're looking at converting to some sort of physical amount. So there are all sorts of complexities, and it really stresses the importance of the finance department working very closely with the sustainability team to understand some of the inherent challenges in the data itself. And the other point I would make is that, and it's there in the COSO framework, but internal control framework, but often overlooked. And that's the cultural dimension to an effective internal control environment.
So one of the things that we hear again and again is from many companies is how did they get started on the pathway and to start thinking about how to address some of these issues. Almost always I will hear something about senior management. Our CFO created some initiative. Our CEO went to Davos and came back with ideas, and there was a lot of initiative and a lot of innovation. In very many cases, it does start with a spark or insight or some step by senior leadership, and then we start to see the 2020 vision plan or something along those lines. And that's where many, many companies first start to get that bigger handle, that broader picture, before they start getting more into the detail.
So along the lines of this spark and the ultimate benefits that are brought up, I've heard you both mention the term value creation. So how does this tie into the concept of the CFO as a value creator?
As we've mentioned, that what we're seeing is that initiating a sustainable business program or projects or initiatives or responding to new investor demand for information or the desire to take a more enterprise approach is the collaboration that takes place. So while much of this grew up in corporate responsibility teams, to take it to the next steps, to invigorate, to bring that business case. When the CFO team, finance and accounting, gets involved, that tends to start to happen. And it also brings in other teams, investor relations. In other cases, it brings in even further collaboration across the enterprise, environmental health and safety people, HR people, because they're holding on to data and metrics as well. And that brings that enterprise view across the organization.
And I'd add, Sherry, that there's a value creation and value construction dimension to this that CFOs are increasingly bringing, front of mind. For example, sustainability issues are often incredibly important risks to a business, and WEF, in its annual survey of global risks, has year on year started to identify that financial risks are less important when it comes to significant business risks. And other factors like environmental and social factors are having a much greater impact in terms of destroying value within companies. And then the other side of that is opportunities. I mean, CFOs, part of their role is to ensure that the company is seizing on opportunities to grow and expand their products and to grow their revenue and markets. So there's kind of two sides to this coin that are important to hold together, that there's a significant risk dimension, so that's why this matters to the CFO, but also there's a significant opportunity dimension as well. And we've seen companies that have become much more sustainable attract a lot more consumer sales, a lot more consumer interest and loyalty. So there is an important dimension here that CFOs, in terms of that intangible value, are starting to recognise.
So just to kind of wrap it up, if someone would like more information about all the stuff we've discussed today, where can they go and what resources do you recommend?
Yeah, so I will say that one of the things that I'm observing is an incredible uptick. Some of the things that we've observed in the past are changing, and they are changing fast. So in the past maybe year to year and a half, there's been an incredible movement. Investors are a big driver. Attention to climate change is a big driver. The concerns of the next generation as millennials take more prominent roles and actually become investors. So we're seeing a lot more attention and movement. So we at IMA are going to be looking into these issues, how we can support our constituents in the accounting and finance roles as they learn and evolve and take on some of these broader concepts. For the specific issues of enhancing the quality and internal controls over sustainable performance information, I invite our listeners to review a paper that we produced a few years ago by Jeff Thompson, our CEO, along with Bob Hurst, who's the former FASB chair and a member of the SASB Oversight Board today. They put out a paper a few years ago that actually looks at applying the COSO principles to these new information forms, and a summary of that was published recently in the CPA Journal of the New York State Society of CPAs. I also want to just say how thrilled I am to be collaborating with the World Business Council for Sustainable Development and the great research and work that they're doing. Thanks, Mario.
Thanks, Sherry. And in terms of our resources, as a member body, and our members are some of the largest corporations in the world, we have worked with companies to take the COSO work, for example, on enterprise risk management, and look at how ESG-related issues can be embedded within that process. So it's not about a new process, it's about a much more integrated process. And so we have available on our website, which we produced in conjunction with COSO, guidance for applying enterprise risk management to environmental, social and governance-related risks. And we also have, on the specific topic of internal controls, guidance on improving the quality of ESG information for decision-making. And we developed that with companies in Denmark and the Danish accounting body there, FSR. So it's very much a kind of practical guide in terms of where to start and how to progress on this journey to ensuring that we have much more credible ESG information. And so we're thrilled to be working with IMA on this project, and our common interest really for the profession really to advance and really step up to the challenge that the world and all the turmoil is presenting for accountants in having businesses succeed in environments that are a lot more uncertain and a lot more volatile in the past, and ensuring that value is created nonetheless.
This has been Count Me In, IMA's podcast, providing you with the latest perspectives of thought leaders from the accounting and finance profession. If you like what you heard and you'd like to be counted in for more relevant accounting and finance education, visit IMA's website at www.imanet.org.